The stock market at times can be so fickle. History has repeatedly proven that quick crashes wipe out years of gains in the matter of days. Are you prepared if the next crash hits? This video is going to show you 10 key strategies that not only protect your investments, but also ways to take full advantage of a market downturn. With these steps, you'll be better prepared for the uncertainty ahead. Stick around to the end for a surprise tip on investing in one asset class that does well in such volatile markets. And don't forget to subscribe for more insights on personal finance and investing. Number 10. Analyze your portfolio. The first step in preparing for a likely stock market crash is analyzing your current portfolio. Each stock and investment should be weighed in terms of long-term value, risk, and contribution it will make to major financial goals. Those stocks categorized as high risk, which might have performed well in bull markets, may leave you with substantial losses when the stock market crashes. First, begin to categorize your investments according to levels of risk and understand the role of each stock. Equally important is a reassessment of your risk tolerance. Will you panic and sell off assets on a crash, or have confidence that will see you through the storm? A stock taken today of your portfolio will help realize any vulnerability and make changes immediately before it's too late. Number 9. Take advantage of market dips. While the stock market crash can be the cause of panic, on the other hand, it contributes to a buying opportunity. At a time when stocks drop, you can buy valuable firms at a bargain. This is what's called buying the dip. Since one may or may not be able to time the market right, one can still gain from buying good stocks after their prices fall. But again, this calls for preparation. Start building your emergency funds and liquid reserves that can cater to your day-to-day expenses or long-term needs such as retirement. These buffers will give you the capabilities to grab the opportunity of a downturn without compromising your financial security. Buying during the market's dip can be quite rewarding in the long run, provided it is done after much research and patience. Number 8. Invest for the long term. Many get panicky when the stock market crashes. In any case, the idea is that selling on a downturn only increases the amount of loss. Long-term investment. The philosophy has been preached by big-time investors like Warren Buffett for years. Of course, a crash is best gotten through by sustaining a long-term investment perspective. The downturns are temporary, and history has shown markets recover over time. Instead of attempting to time your investments in the market for its ups and downs in the short term, it is better to work on a portfolio that will grow over the succeeding 10, 20, or even 30 years. In this way, temporary losses due to a crash will barely have any impact on your long-term returns. The key here is not to give in to the urge to sell in the midst of a crash and have a little faith that your investments will bounce back. Number 7. Diversify your investments. One of the best ways you can protect yourself during a stock market crash is through a diversified portfolio. You minimize the impact of a sector or asset class going down, since your investments will be spread across sectors and major asset classes. For example, if you have all of your money in tech stocks and that sector crashes, then your entire portfolio could take a huge hit. It is a hedge against possible risk due to overexposure in those markets. However, diversification into other fields such as real estate, bonds, or commodities reduces your overall risk. You can even diversify outside traditional assets into investments like fine wine or other collectibles. The broader and more balanced your portfolio, the better positioned you will be to weather a stock market crash. Number 6. Reallocate risky assets. Not all investments are created equal, especially when the market is down. Some stocks and sectors will go in harder than others, and it is more critical now than ever to appraise the risk in your portfolio. During a crash, high-growth stocks may fall further compared to solid, blue-chip companies or even much defensive sectors like utilities. When these investments reach a risk level you are uncomfortable with, it may be time to trim or exit a position. On the other hand, making sure some of your money is invested in more stable, dividend-paying stocks and other investments, such as bonds, will help cushion the blow of a market crash. If you're not certain how to judge the risk in your portfolio, consider hiring a financial advisor for a professional portfolio review. Number 5. Implement dollar-cost averaging. Timing the market is an impossible strategy to get right. Rather than trying to time the highs and lows, consider using dollar-cost averaging. This just means investing a fixed amount of money at regular intervals regardless of how the market is doing. The longer dollar-cost averaging is done, the less risk in buying at market highs. It allows you to gather more shares and lower the average cost of your holdings, especially when markets are down and prices become depressed. TTR removes some of the emotional aspects concerning investment and helps you build a portfolio on an ongoing basis, even in periods of volatility. Number 4. Invest in dividend-paying stock. Dividend-paying stocks absorb some of that blow with a source of income, even in bear markets. These are stocks of companies that distribute a portion of their earnings to shareholders, usually on a regular basis. If the stock prices for the same company tend to go down in the event of a market crash, these dividends provide a guaranteed source that cushions your portfolio against drastic volatility. Dividend-paying companies mostly have well-established and financially sound businesses, hence less volatile in their stock market. Dividend payoffs are of course not guaranteed and are reduced whenever earnings fall, but this helps in reducing the rate of damage during crashes if the portfolio is made up of strong dividend stocks. Number 3. Build an emergency fund. You want a large amount of money in your emergency fund to be sure that you can survive a market crash. That 3 to 6 month window allows you, with a supply of cash on hand, to avoid having to sell any investments when their values are low. It gives you the opportunity, in case you were to lose your job or needed some kind of expensive repair fairly unexpectedly, to pay those costs without depleting your investment portfolio. This liquidity ensures you are not forced to sell your assets in a bear market when values are depressed. To start building an emergency fund, begin by allocating part of your income towards savings every month. This will go a long way in easing your mind and helping you stay on track during a market crash. Number 2. Utilize tax loss harvesting. If your portfolio suffers some losses during a market crash, tax loss harvesting can help you offset the pain. Tax loss harvesting means rebalancing some of your lagging investments to reduce your taxable income. The losses can be used to offset capital gains from other investments or carried over into future years. You can reinvest in similar investments after 31 days of the sale of the depreciated assets to avoid what the IRS terms as a wash-to-sell rule. This way, you stay invested but reap the possible reduction of your tax liability. Tax loss harvesting is an advanced strategy, and it's recommended to consult with a tax professional so as not to get in trouble with the rules or misinterpret the benefit. Number 1. Avoid trendy social media. Social media can be an echo chamber when a stock market crash is imminent. Yes, the investment advice of social media influencers, threads on Reddit, and tweets can be really seductive, but it would not augur well by following them. A number of such platforms advise speculative investments or very short-term trading strategies that do not align with your financial goals or your threshold of risk. Instead of reacting to the noise, a well-researched, long-term investment strategy is what you should follow. Always make decisions based on satisfactory research and expert advice, never on trends that could disappear as fast as they began. Being away from socially driven advice on investments will help you make rational decisions and protect your portfolio in case of uncertainty. The bottom line is that preparing for a stock market crash means making wise and intelligent decisions. You'll be able to protect your investments far better and capitalize on opportunities which will present themselves during the downturn by organizing your portfolio, re-diversifying, investing for the long term, and avoiding bad, intoxicating trends. Thanks so much for sticking around to the end. I hope these strategies gave you some valuable insights on how to navigate the ups and downs of the stock market. If you have any questions or thoughts, drop them in the comments. I'd love to hear from you. And if you found this helpful, make sure to hit that like button and subscribe for more tips on personal finance and investing. See you in the next video.